Hey guys, welcome back to part 4 in this ultimate guide to Bitcoin fundamental analysis. This topic is actually my favorite topic, talking about market timing tools. So in the first 3 videos, we talked about the basics of token economics, we talked about Bitcoin's growth metrics and valuation models. Now we're going to talk about market timing tools, and then in the next video, we're going to talk about off-chain factors. Now, I really love trading and investing in Bitcoin because we have metrics and tools that you just don't have in other markets. And so before we dive into those, let's talk about what are the goals of market timing? So the first and pretty much most obvious is to help you buy low and sell high. And ever since the early days of Bitcoin, I've been doing videos trying to educate people and help people become better investors. And it doesn't matter how many times I teach strategies and the philosophy of buy low, sell high. The reality is that 90-something% of people are going to inherently keep doing the opposite, right? People that know better are still going to do the exact opposite. So it really doesn't matter if I give away all my secrets or if we have 10,000 or 100,000 members in our investor community, because most people are just not going to do the wise things that actually make you a profitable investor. But hopefully you're different, and hopefully you'll take these to heart and actually put in the work to develop your skills and learn how to apply this stuff. Now, the next goal of market timing is minimizing drawdowns. Now, a drawdown is when you buy something. It could be a stock, it could be Bitcoin, it could be gold, a house, whatever, and the price actually goes down or against you after you buy. And it's very rare, unless you're buying a breakout, that you're gonna be in profit from the very first second and you're never gonna have a drawdown. But with market timing tools, the goal of that is to minimize those drawdowns. So you're buying at areas and places in time where the drawdown is somewhat limited. And the third thing we're looking to do with market timing tools is we wanna enter and exit positions at key inflection points. And what that means is you want to be getting in and out of the market at key pivot points. You know, I recently looked at all my data from all my active trades and my investments in crypto, and pretty much 9 out of 10 days, I'm not doing anything. Right? Meaning there's no action required on a trade or an investment. It's only those key moments that come along every few weeks or months that I actually need to get in or out of something. And so hopefully with these market timing tools, it'll remove a lot of the noise, a lot of the chop, and a lot of those just kind of mid-trend areas where if you're in a position, you just let it work and you don't really need to do anything. And the fourth thing we want to do is remove guessing and FOMO chasing. So what a lot of people do, and if you're new to the markets, maybe you've done this, where you look at the price or you look on Twitter and you see a whole bunch of people bragging about how Bitcoin's up a ton, and you just find yourself FOMO buying. Basically, the fear of missing out gets you into really sticky situations where you know inherently that you should be buying low and selling high, but you're doing the opposite because you get caught up in FOMO, or you just really don't know where is a good area to buy and where's a good area to sell. And the final goal is to stay on the right side of trends and just avoid getting run over. Bitcoin is a really volatile market, which is good and bad in certain ways. The volatility is really, really profitable for active traders that know what they're doing, but it can also be a death trap if you basically let your emotions drive decisions. So throughout these lessons, because this is my specialty, in this video, I want to show you just not what the tools are, but how I actually have applied them in the past, maybe so you can start to apply them for yourself as well. And one thing I want to point out here is market timing is not about perfection. It's damn near impossible to pick exact tops and bottoms over time. There will probably be times that you get pretty close to it and you get lucky, but over time, the goal is not to always pick the exact bottom and the exact top. Really what you want to do is catch the meat of the move. You know, you want to catch the majority of a trend. You also want to get in at key zones, remove emotions, and let the trend do the heavy lifting. Another mistake I see newer traders making is they try to short when a trend is intact, or they try to guess where a top is and they close too early and they miss out on a really big trend. So with that said, let's go ahead and dive into all of the different dozen or so market timing tools that we have at our disposal. So most of these fall under the category of looking for market tops and bottoms on the bigger market cycles. And I recently did a video talking about the best time to buy Bitcoin and the criteria that you can actually backtest for yourself and see why this is the best time. So I'll link that up if you haven't seen it. But the reality is with all these tools is there's not one that you can use that's going to be right 100% of the time. It's when you start to pull them all together that you can begin to find an edge. So the first one we're going to look at is what's called the net unrealized profit and loss. So let's go ahead and jump over to glassnode.com, which is a website that has a lot of these tools that I use. And I'll link this up below if you want to get signed up with them. But here under the dashboards tab, you can see that they have something called market tops and bottoms. And there's a handful of tools that they have pretty easily organized here that you can go through. And the first one is net unrealized profit and loss. And if we blow this up, you can see I have price with a logarithmic chart overlaid with this indicator. And if we just look at the description really quick, net unrealized profit and loss is the difference between relative unrealized profit and unrealized loss. And there's a good article that I'll link up that explains the methodology and the math behind this indicator. But essentially what we're looking at here is areas of extreme capitulation, meaning people are just dumping their bags and selling at lows. And then on the other extreme, you have euphoria and greed when price action is going parabolic to the upside. And one thing that you can look back on is see that the best times to buy are typically when this indicator is in extreme capitulation. This is where people are panic selling out of these markets. And if you do the opposite of what most people are doing, that's where you make money being an active trader and investor. And conversely, when the market gets way overheated and people are just FOMO buying into all-time highs, this is typically where tops come into the market. And we also have net realized profit and loss. And this is just slightly different where it looks at the profit and loss for all moved coins. And just like you want to buy when there's extreme capitulation, and sell when there's extreme parabolic FOMO buying. And the second tool here is percent supply in profit. And if we look at percent supply in profit using a 90-day moving average, you can see this kind of works like an oscillator where on the lower side here in the green zone, anytime you get into like the 40 to 50% area, that typically turns out to be a good time to buy. And when you have, 90% or more of people that are in profit, that's when it is typically a good time to sell. And the next one is what's called the HODL wave. This is a percentage of all the coins in the Bitcoin ecosystem that have not moved in over a year. And when you overlay the HODL wave, which is this yellow line, over Bitcoin's price, you can see that key inflection points of pivot highs typically line up with pivot lows in the HODL wave, and pivot lows in price are somewhat close to pivot highs in the HODL wave. Now again, this isn't an exact science, but what you can look for is when you're in the bottom end of that range, typically that means that a lot of coins are moving, and on the other side, that can also be true for good times to buy. And then the next thing we're going to look at is in and out of the money price zones. And this is one that you can find on Into the Block. I'll link this up below as well. But basically what they do here is they break up price levels into different sections where you can typically see where there's either a lot of bag holders at that price or a lot of resistance. Now, at the time of recording this, there's not a whole lot of sellers or possible sellers. There's mainly holders at this point, but the lower you are in the price history, the more red you'll have here. And this can basically show you where there's going to be strong areas of support and resistance, or where pop stop runs can come in. So the theory here is when you know a lot of people have bought in at certain prices, that can either be an inflection point where they're gonna wanna buy more, or even panic sell. So as you start to break through a price level where there's been a lot of trading activity, that can actually add fuel to the fire on both the downside and the upside. And the next one here is exchange balances, if they're either increasing or decreasing. Now, we've actually talked about exchange balances in in a couple of the past videos in this series. But what I'm going to talk about now is more of like a way to use this to figure out if coins are being pulled off or added to these centralized exchanges. And you can see periods of time where the capital on exchanges is either flat or going down. Those can be indications that we're actually entering an accumulation period. Think about it this way. If everybody's pulling their coins off of exchanges, what are they doing with them? The most likely scenario is they're putting them on cold storage or hardware wallets. Conversely, if everybody's moving their coins from cold storage to exchanges, that's probably an indication that they're looking to sell. And you can see when there's big parabolic price moves, that's typically when you get a really sharp and fast increase in the coins sitting on exchanges. So while this one isn't necessarily the best indicator of pivot points in price, it can just help you understand what the order flow is doing and what people are doing with their capital. So it's just, again, one more insight that you can add to your arsenal. And another tool we can use is what's called the stock to flow deflection. Now, in past videos, we talked about the stock to flow ratio, which is basically a model for how we can anticipate Bitcoin's price growth over time to kind of match up with the halving every 4 years. The stock to flow deflection actually shows the ratio between the actual Bitcoin price and the stock to flow model. So basically what that means is if the deflection is greater than 1, it means that Bitcoin is overvalued at that point in time, according to the stock to flow model. Otherwise, if it's below, that means it's undervalued. And again, you can line this up on the price chart and see that when we get into this green zone, that means that we are underperforming the stock to flow model. And when we're in the red zone, that means we're getting ahead of that. So again, if we look at the stock to flow ratio, you can see price is not an exact science. It doesn't exactly stick to this, but when it gets way ahead of itself, that's when you know it's potentially overvalued, and when it gets below that line, it means it's potentially undervalued. And like we said in the last video about valuation models, value is really subjective, and Bitcoin is such a complex market because it's global in scale, right? It's not like the US stock market, which is somewhat limited to market participants. It's also more diverse than gold, even, you can make an argument for. So there's so many variables that go into this that I don't want anybody to look at this and think, oh, okay, I'm just gonna blindly buy when any one of these indicators goes into a buy zone or a red zone for sell. It's really about approaching it and having a plan and being able to structure that according to your own risk tolerance. So I'll actually give you some examples of different strategies that you can implement if you want to be a market participant in Bitcoin and maybe even other crypto assets. And the next tool is what we call the Puell multiple. So the Puell multiple, if we look at this with a 7-day moving median, you can see this also moves like an oscillator where it gives us a green zone and a red zone. And if you overlay that on price, it gives you an indicator of when things are overheated versus underheated. So basically what you're looking at is whatever the block reward is that comes out every 10 minutes or so. And then you divide that by the 365-day moving average of daily issuance value. And I'll link up this article if you want to go into more depth and learn how this is actually calculated. Now, the next one I think is really cool. It's market cap to thermocap ratio. And this is really measuring and looking for what I call parabolic runs. And you can see that this one is very similar to the Puell multiple, but price tends to hang out in the green zone a lot longer and really only gets up into the red zone on parabolic moves. So basically, in my opinion, this is more of a better sell indicator than a buy indicator. But you can see once you start to get up in that red zone, that has historically been a really reliable way to find market tops. And the next one is the difficulty ribbon compression tool. And we talked about the difficulty ribbon in a prior video, but what the compression tool is looking for is when these moving averages kind of compress or squeeze together. And if we jump over here and actually look at the ribbon compression, it again kind of visualizes this in a oscillator where it shows you good buy zones. So just like the market cap to thermocap is a good market top indicator, the compression on the ribbon is typically a good buy indicator. And the next tool is reserve risk. So reserve risk, again, is also an oscillator. And what this is looking to do is trying to measure risk to reward and confidence. So basically, when confidence is high and price is low, there's an attractive risk to reward for investors. And when confidence is low and price is high, then it's kind of inverse reward to risk ratio, right? So again, if you go back and backtest this, you can see when we're in the green zone, typically a good buy indicator. When we're in the red zone, those are typically correlated with market tops. And the final one is drawdown from the all-time high. So in my video where I talked about the best time to buy Bitcoin, I alluded to the drawdown from the all-time high, which means where is price relative to the highest price that Bitcoin's ever traded at. And anytime the current price is on sale by 80% or more, those are typically the juiciest and best buying opportunities for risk to reward, which can again help you have a smaller drawdown. Okay, so I know that was a lot and it might sound overwhelming, and it's probably a good idea to go back and just look at all these indicators and see how they correlate together and how powerful they can really be. But indicators and tools and forms of analysis alone are really worthless until you combine it with a strategy to actually be able to effectively use these market timing tools. So what's included in a strategy? Well, you first need to think about things like your capital buckets, hold times, and then specific strategies. So what does that mean? Well, your capital buckets are basically money that are allocated to specific hold times and or different strategies. So you basically look at your net worth and then you say, of my net worth, what percentage of that do I want to use as risk capital that I'm going to invest or put in the markets, either as an investment or a speculation or a hedge, right? And then you say, of that capital that I'm going to use for investing, what are the different time frames and the different strategies that I want to use, and how do I want to break that money up? And so the second step here is with hold times. What is the average period of time that you hold a position? And then a strategy is, what is the decision-making process that you use for buying and selling? And you might be somebody that's like, look, I only want to approach the markets with one capital bucket, one hold time, keep it super simple. Or you might be somebody like me who's like, I just want to maximize profit potential any way I can, right? Have multiple capital buckets, use multiple strategies and multiple hold times. And there's really three different, I guess, categories or types of strategies that we can look at. The first is what I call the hodl / cold storage / shit hits the fan scenarios, where basically what you're looking to do is you accumulate at undervalued price levels and then you never sell. So hodl, for anybody that doesn't know, means hold on for dear life. And it's basically a play on the word hold, right? Where you buy and you just hang on, right? Now, the people that buy when price is going parabolic or into kind of the red zone areas, those are the ones that, even though they know they want to be a hodler, they are more apt to panic sell on price dips because their risk to reward isn't favorable. So if all you get out of this video series is, hey, accumulate at these undervalued levels and then hang on, that's going to put you at a significant advantage to most market participants in Bitcoin. Now, the second type of strategy is what I call cycle trading. This is where you're buying at capitulation levels and then you're selling into euphoria. And the typical hold time for this is anywhere in between like 1 to 2 years. And while trading isn't for everybody, this is a way that you can really juice up your returns. Instead of just buying and holding, you can buy and accumulate Bitcoin in those kind of green zones where prices are depressed or when you have a big sell-off quickly. And then you sell after you have a full market cycle plays out where prices go parabolic and get into those euphoric areas. And my philosophy with cycle trading is like this. I want to accumulate Bitcoin and trade for Bitcoin when it's cheap. And then I want to accumulate fiat currency and trade to accumulate more dollars in my bank account when prices are expensive, so I can have even more dry powder or capital when prices fall again, and I can over time increase my position sizes. You know, when I first got into Bitcoin, I basically played with smaller sizes and then ended up with over half of my net worth in Bitcoin. And I did that relatively quickly just by doing these kind of cycle trading strategies. And then the third type of strategy is technical swing trades. So this is where you're being even more active, where you're buying dips, you're buying breakouts, and you're being more active during bull markets and catching those trends. And a typical hold time is anywhere from a couple of weeks to a few months. So just to give you a little context here, if we look at Bitcoin's chart, one thing I marked up here was the accumulation periods or ranges, and you can see we've had 3 over the past several years. And when you line up a lot of these market timing tools, you'll start to get buy indications in these zones. And when we go parabolic and we start to go exponential to the upside, that's where you start to get a lot of these sell indicators. So again, when it comes to accumulation plays or that cold storage bucket, these are the moments in time that I'm buying and stuffing away Bitcoin, right? I'm not buying and trying to hold Bitcoin when it's going parabolic. I'm really looking for these kind of deeply depressed price levels where there's either a big sell-off where you're 80% or more off the all-time high, or where you get like a 50% sell-off in the course of 1 or 2 days, like I talked about in my timing video. But also, in addition to this, when you are in these bull markets where price is trading to the upside and seeing that exponential growth, if you want to be more active and add juice to those returns in these bubbles, this is where you can actually be more active by buying breakouts, buying dips, and really looking to juice those returns. Now, again, that takes more of a skill level, but if you're willing to put in the work or at least understand the basics, that can be a really profitable way to grow your account, especially if you're starting with a smaller amount. That's how I did it in the early days back here in 2013. I was accumulating, but I was also trading on the way up and then trading on the way down. And volatility is scary to the average person who doesn't understand markets, but it is a trader and an investor's dream, right? When you have a market that's this volatile, because it just creates more opportunity. And this is where the skill level really needs to be a little bit higher, and where you really need to make sure you're on your game, because you can make a lot of money trading breakouts and dips if you are lazy, or if you just don't have the right tools and strategy here, you can also get run over. So keep that in mind. But I'm a huge fan of being more active during bull markets, because you just let the trend do the hard work. And the final strategy, which I'm going to mention, but I don't really suggest for anybody, is scalping or day trading. This is where you're actively trading wild volatility. And I've talked about day trading on my channel in a lot of videos. And while I used to be an active day trader, I think in today's competitive landscape, meaning the way that the markets are structured, it is very, very difficult, if not damn near impossible, to make a living day trading. There's a lot of studies that have been done on this that prove that almost all day traders lose money. And while I will take the occasional day trade, it has to be a very unique set of circumstances where, maybe it's something like Bitcoin sold off 10 to 15% in an hour or two, and maybe we can get a large percentage bounce. But if you're just going in every day hoping to make a living scalping Bitcoin's price, you are going to get eaten alive. So that's just one thing that I think nobody should do. And my motto is trade less, profit more. You can choose to be at whatever level you want to be here, but just know that the more active you are, the more margin for error there is, and the higher your skill level and discipline has to be. So I hope that's helpful, guys. I know there was a ton of stuff in this video. In the next video, we're going to be talking about off-chain factors. So stuff that impacts the price of Bitcoin, but doesn't actually have to do with the transactions on the blockchain. So again, if you enjoy these videos, give it a thumbs up. Let the YouTube algorithms know that this is great content, and share it with anybody you think would get value from it. And I'll see you in the next video.